3 days ago, something happened that millions of Americans have been waiting 4 years to see. Mortgage rates fell below 6% for the first time since 2022. The 30-year fixed rate dropped to 5.98% as of February 26th. And if you've been paying attention to the housing market for the last few years, watching rates climb from 3% all the way to nearly 8% and wondering if you'd ever get a shot at buying a home, this sounds like the news you've been waiting for. Every headline said so. Real estate agents are celebrating. Mortgage brokers are calling their clients. The White House put out a press release taking credit for it. And for about 48 hours, it genuinely felt like the housing market was finally turning a corner. And then, the data came in. And I'm going to show you today that lower mortgage rates aren't going to fix the housing affordability crisis. They might actually make it worse. Not because rates don't matter, they do. But because the mechanism that broke the housing market in the first place is still completely intact. And a 0.5% drop in interest rates isn't going to touch it. Which brings us to the lock-in effect. And this is the most important concept in the entire U.S. housing market right now, and nobody is explaining it clearly enough. Here's how it works. Between 2020 and 2022, the Federal Reserve cut interest rates to essentially zero to support the economy through the pandemic. Mortgage rates followed. At the bottom, the average 30-year fixed rate hit 2.65%, the lowest in recorded history, and millions of Americans, the smart ones, locked in those rates. They bought homes, they refinanced, they secured payments that felt almost impossibly cheap by any historical standard. Then, the Fed hiked fast, aggressively. The fastest rate increase cycle in 40 years. Mortgage rates went from 3% to nearly 8% in less than 2 years. And here's where the lock-in effect activates. Because those homeowners who locked in at 2%, 3%, 4%, they're not selling. Why would they? Moving to a new home means giving up their 3% mortgage and taking on a 6% mortgage. On a $400,000 home, and that's the current median U.S. home price, the difference between a 3% rate and a 6% rate is roughly $800 a month. Every single month, forever. $800 a month. That's $9,600 a year. That's a car payment and a vacation and 3 months of groceries just gone because you moved. So homeowners stayed put, and the housing market essentially froze. Let me give you the numbers because they're staggering. Right now, 52.5% of all American mortgages are at rates below 4%. 52%. 70% are below 5%. And 80% are at or below 6%. Which means that as of today, even with rates at 5.98%, the majority of current homeowners still have no financial reason to sell, because selling means upgrading to a rate that's the same or higher than what they already have. And when homeowners don't sell, inventory doesn't exist. And when inventory doesn't exist, prices don't fall. And when prices don't fall, the people who actually need cheaper housing, first-time buyers, renters trying to get out of a $1,800 a month apartment, young families who've been waiting years for the market to come back to earth, they're still locked out, just from the other side of the door. Meet Jamie. Jamie is 29. She's not trying to get rich. She's not flipping houses. She's a nurse practitioner in Charlotte, making $87,000 a year, which sounds like decent money until you run the actual math. The median home price in Charlotte right now is $387,000. At 5.98% on a 30-year fixed with a 20% down payment, which is $77,400, by the way, which Jamie absolutely does not have sitting around. Her monthly principal and interest payment comes to $1,850. before property taxes, before insurance, before HOA fees, before the fact that her student loans are still $340 a month. Her take-home pay after taxes is about $5,400 a month. And after the mortgage, the loans, utilities, food, and car payment, Jamie has approximately $200 left per month to live. Jamie cannot buy that house, not at 6%, not at 5.5%, not at 5%. The math doesn't work until rates get back to somewhere around 4.5%, and nobody is projecting that for 2026. Not Redfin, not Realtor.com, not JP Morgan, nobody. And here's the gut punch that makes this even darker. The people celebrating the rate drop this week are mostly people who already own homes, because lower rates mean their home equity grows. Lower rates unlock refinancing. Lower rates make their existing asset more valuable. The people who already won the housing lottery in 2020 and 2021, they win again. And Jamie? Jamie is still standing outside looking at the menu she still can't afford. Which brings us to what actually happens next. Because here's where the mechanism gets really uncomfortable. Lower mortgage rates don't just help buyers. They also unlock demand. More people who were sitting on the sidelines because rates were too high suddenly enter the market. And what happens when more buyers enter a market that still has almost no inventory? You know exactly what happens. Prices go up. Redfin is already projecting home prices will rise another 1 to 2% in 2026. Realtor.com says the same. JP Morgan predicts prices stall at 0% nationally. And even that assumes the supply situation improves, which it might not. And if rates drop fast enough to unlock a significant wave of new buyers before inventory catches up, the affordability gains from cheaper rates get immediately erased by higher prices. It's a feedback loop that works against the people who need relief the most. Lower rates leads to more buyers, leads to more competition, leads to higher prices, leads to affordability stays exactly where it was. The treadmill keeps moving. Nobody actually gets ahead. And the historical parallel here is almost too obvious to say out loud. But I'm going to say it anyway, because apparently it needs to be said. 2003 to 2006. The Fed cut rates aggressively after the dot-com crash and 9/11. Mortgage rates fell to historically low levels. Housing became more accessible. Demand surged. Prices went up and up and up. Lending standards loosened to keep the dream alive for people who couldn't quite afford it at any price. You know the rest of that story. 2008. The worst financial crisis since the Great Depression. Millions of foreclosures. $11 trillion in household wealth destroyed. Now, am I saying 2026 is 2008? No, the lending standards today are dramatically stricter. Most homeowners have real equity. Subprime isn't running the show this time, but the pattern. Cheap rates creating a demand surge that outpaces supply and inflates prices beyond what fundamentals support, that pattern has a track record. And pretending it can't happen again because this time the loans are better quality is exactly the kind of thing people say right before it happens again. So what does all of this actually mean for you? Because this is the part that matters. Depending on where you are in this story, your next move is completely different. If you're a current homeowner, lower rates are genuinely good news. Your home value is supported. If you're sitting at 7% or above from a 2023 or 2024 purchase, refinancing now is worth running the math on seriously. Mortgage refinance volume is expected to jump more than 30% in 2026. Get ahead of that wave before lenders get overwhelmed and service quality drops. If you're a first-time buyer waiting for the perfect moment, here's the uncomfortable truth. There is no perfect moment in this housing market. Rates at 5.98% are still historically normal. The 50-year average on a 30-year mortgage is around 7.7%. If you have the income to support the payment without stretching dangerously, and you're planning to stay for at least 7 years, the rate today is workable. If you're stretching to make the payment work at 6%, do not do it. Because the buffer you don't have today is the financial crisis you live through in 2 years when the car breaks down and the roof needs replacing. If you're a renter trying to decide whether to keep renting or push to buy, the rental market actually has some decent news buried in the data that nobody is talking about. National median rent in January 2026 was $1,353, down 6.2% from its peak. Apartment vacancy rates have climbed to 7.6%. The rental market is the most renter-friendly it's been since 2019, which means if you're renting right now, your leverage just quietly improved. Use it. Negotiate. Your landlord is more motivated than they've been in years. And if you're a real estate investor watching rates fall and thinking about jumping back in, just remember that cap rates on rental properties are still compressed. Insurance costs have gone vertical, up 20 to 30% in many markets since 2022. And the supply of new apartments coming online is higher than at any point in 40 years. The returns that looked obvious in 2019 are not obvious anymore. Run the actual numbers, not the vibes. Here's the uncomfortable truth that wraps all of this together. The mortgage rate drop below 6% is real. It's not fake. It's not spin. And for some people, specifically people who bought at 7% or 8% in the last 2 years and can now refinance, it is genuinely meaningful. But for the Jamies of America, the millions of first-time buyers who have been sitting on the sidelines waiting for their moment, a 0.5% drop in rates on a $400,000 home saves you $127 a month. That's not relief. That's a rounding error on the problem. The housing affordability crisis wasn't created by interest rates alone. It was created by a decade of underbuilding, a pandemic-era buying frenzy that pushed prices 40% higher in 3 years, an insurance market that has gone completely off the rails in coastal and weather-exposed markets, and a lock-in effect that has frozen the largest generation of homeowners in the most favorable mortgage positions in history. None of those things were fixed this week when rates crossed below 6%. The headline was real. The relief is going to require a lot more than that. So I want to hear where you actually land on this. Do you think A, the rate drop below 6% is genuinely the beginning of a housing market recovery, and prices will stay stable while affordability gradually improves over the next 2 to 3 years? Slow, boring, but it works? Or B, the lock-in effect and lack of inventory means lower rates just create another demand surge that pushes prices higher, and the affordability crisis gets worse before it gets better? Or C, something nobody is talking about, that the only thing that actually fixes housing affordability is a recession that forces sellers to list and buyers to pull back, and that the fix everybody's been waiting for is going to feel a lot worse than the problem? Drop your answer in the comments. Because I promise you, the comment section on this one is going to be more honest about the housing market than anything your real estate agent is telling you right now.